Good day, everybody. Welcome to the second half of the semester and the beginning of Chapter 11. Here we're going to be talking about the level of prices and the value of money. Let's take Bangladesh, for example. Bangladesh, of course, we know it as a poor country, right? Their per capita GDP is 1,203 US dollars per year. That's quite low, especially compared to our country here in Canada. We're a pretty well-off country here in Canada. Bangladesh, the central bank overnight rate is 6%. I mean, they have a lot of room to lower their interest rate, to encourage banks to borrow reserves so that they can loan out more money and create more money. In other words, they have a lot of ability to increase the money supply. Hey, why don't they? Why doesn't Bangladesh just create a whole bunch of money so they can be rich like America and like Canada? Why don't they do that? Well, the answer is it doesn't work. Just creating more money and increasing the money supply does not make a poor country into a rich country. It's much more complicated than that. If you remember from chapter 1, basically we said that a country's wealth depends on its ability to produce goods and services. That's what can affect a company's wealth. You might also remember one of the principles of economics that says if a country prints too much money, they will cause inflation, right? So we have these two different factors. That's what this chapter is all about. We examine why just printing a whole bunch of money does not make a poor country into a rich country. All right, so obviously when we increase the money supply, we can create inflation. What is inflation? Inflation is the increase in the overall level of prices. Deflation, on the other hand, is the fall in the overall level of prices. So anyways, these four gentlemen right here, they wanted to understand why is it if they knew intuitively, they knew from history as well, that whenever a country would print a lot of money, that would cause a lot of inflation. Okay, so basically we're going to analyze that as these early classical thinkers in economics did. What is actually going on here? Can we create up a model whereby we can understand the relationship between the money supply and also inflation? What is that connection? How does this work? The price level, or the amount of inflation or deflation that is in the economy, the price level can be really viewed in two different ways, right? When you think about inflation, okay, it's obviously the price of a basket of goods is getting more and more and more expensive, but we can look at it the other way as well, right? We can see that inflation actually destroys the value of that money. Now look at the picture on the slide. We can see that $20 in 1988 bought you a lot more goods than $20 in 2013 does. Therefore, we can say that as prices increase, the value of money decreases. All right. So anyways, how is the value of money really determined? How is the price level, in other words, really determined, right? Well, it's determined by the forces of supply and demand, right? Now we can think of the supply as basically controlled by the Bank of Canada. Currently, the governor of the Bank of Canada is Stephen Poloz, right? So Stephen Poloz, basically, he decides what the money supply is, and it's fixed, and it's independent of other variables. So it's completely inelastic. And when he wants to increase the money supply, he can either change the reserve ratio, he can do open market operations, or he can change the overnight rate to encourage banks to borrow reserves from the Bank of Canada so that they can loan more money out throughout the financial system, according to the money multiplier. Again, that's just stuff we've always studied in the past. Basically, for our purposes right now, we are going to say that the money supply is fixed until the governor of the Bank of Canada decides to change it. All right, so the demand for money reflects how much wealth people need to keep in liquid form. What is their liquidity preference, right? So there's a trade-off for having money in the bank account. There's an opportunity cost to that. If I have money, a whole bunch of money sitting in the bank, then, first thing, there's stuff that I could buy. I could buy a new car, I could buy a house, okay? But there's also returns that I'm also forfeiting by having money in my bank account. Maybe, I could be making money in the stock market, right? So I could have that money making a return in the stock market or the bond market, so to speak. So there's a trade-off for having money in the bank. So there's many factors that affect the demand for money, including number one, transaction demand. If I want to pay my rent and pay my bills and buy groceries at the store and buy gas or go on a vacation, right? I need money in order to pay for those transactions. But there's also a precautionary demand, right? Some people, I think it's a good idea as well, is to have an emergency fund in case something goes wrong, your car breaks down. Some people keep $3,000, $4,000, $5,000 in the bank just in case. And they always keep that money there just in case. So when something breaks down, they don't have to go into debt in order to pay for that. A third is an asset demand, right? Some people might be holding money as a store of value. It's not always advisable. Sometimes when the stock market starts going down, you'll see investors actually move to cash, right? It's known as a store of value when perhaps there's market fluctuations or volatility where people don't want to get involved in that, right? But the fourth and the most important variable explaining the demand for money is really the level of prices in the economy. Higher prices equal more money demanded in the economy. If the prices for things are going up, for my gas bill is going up, my electricity is going up, my rent's going up, then I'm gonna need more money this month and the next month than I did in previous months. So that does strongly affect the money that's demanded in the economy, across the economy, if more people are paying higher prices for things. Or we can say the lower the value of money, the more money I need to pay for my goods and services. All right, in the long run, the overall level of prices, right, the price level, adjusts to the level at which the demand for money equals the supply for money. And we can see this right here at the equilibrium value of money here, right where supply equals demand. And that basically chooses what the price level is, right? And that's all we're saying. The price level is determined by the demand and supply for money. Pretty easy, right? And you guys remember on the left-hand side, the value of money goes down on the y-axis here, right? And as the value of money goes down on the y-axis on the left, the price level increases on the y-axis on the right. That those two things go hand in hand. As the value of money decreases, the price level increases. Let's examine this graph a little bit more closely. The question is, why is the money demand curve downward sloping like this? The answer is that if the value of money is decreasing, let's say it is 25% of what it used to be, then I'm going to require more money in order to pay for the bills that I have. Groceries are going to be more expensive. My gas bill is going to be more expensive. My rent is going to be more expensive. So I'm going to demand a greater amount of money. I'm going to demand more dollars because the value of that money has decreased. What would happen if the Bank of Canada decided to increase the money supply? What exactly would happen? So I'll draw a straight line, or I'll try to draw a straight line. We'll call that MS, money supply 2. So there's been an increase in the money supply. The quantity of money has grown because Mr. Pelose, the governor of the Bank of Canada, has decided so. So anyways, what happens to the equilibrium in that case? What's going to happen to prices in that case? Well, there's going to be a new equilibrium. It's going to be right here where our money supply equals the money demand. What's going to happen to the price level? What's going to happen to the value of money in that case? Well, there's going to be an adjustment. Because there is new money floating on around in the economy, people are going to be able to buy more goods. Now they can get that car, or now they can get that more expensive car. Now they can get that more expensive house. Now they can go on vacation. There's more money in the economy, which means that they will demand more money. But the quantity of goods available for sale haven't really changed. So what's going to happen is people are going to bid up those prices. So, and that's reflected in this graph. As you can see, at this level, the price level is higher and the value of each dollar has decreased. And that's what would happen if the money supply would increase. If the money supply increases, we get inflation. We get a higher price level. And that is just because we'd be competing for the same amount of goods and we would be bidding up the price.